Portfolio Consistent Compounders. My name is Pramod Gubbi. I'll try and moderate the session for today. I'm one of the founders of the firm and I look after client advisory and relationships. I have with me my colleague Rakshit, who's also a founder of the firm and the portfolio manager of the flagship portfolio Consistent Compounders. As you might have seen, there's been a recovery of sorts in the performance of Consistent Compounders as well as all our other portfolios in the last 6 months. Pretty much all of them have done better than the benchmark. Part of it is for reasons beyond our control. As you can see in the market, there's been a shift towards quality, perhaps a beginning of a long run, which we first faced between 2018 and 20. But part of it is also the result of some of the mistakes that we've addressed. We've talked about these mistakes in many of these webinars. We've talked about the changes we've made to the portfolio in many of these webinars. So to discuss all of that in more detail, how have those changes played out? Where does the portfolio stand today? How are we looking at the universe of quality stocks in the country? I'll hand it over to Rakshit. We will do a fairly extended Q&A session, so feel free to start dropping in your questions in the Q&A box at the bottom of your screen. But prior to that, I'll request Rakshit to set the scene for us.
Sure. Thank you, Pramod. Good evening, everyone. So let me kick off with a few slides before we get into the Q&A. This is the historical performance chart for different time periods. First observation, on an absolute return basis, many time periods have been very healthy and satisfactory, barring the three-year period, which is still a sort of suboptimal 6.5%, 6.2% annualized return. This is the cohort of clients who opened their accounts in 2021. On a relative basis, we continue to underperform on most time periods on this chart, but this part has started to reverse in the last 6 months particularly, and pretty consistently. There's been about 450 basis points of alpha YTD year to date, out of which 200 basis points you can see in the chart itself, the 6-month period roughly, and another 250 basis points in the last 10 days of this month, which is not part of this chart. Just to reiterate, our long-term expectation of returns from this product, we believe CCP can deliver 18 to 20% CAGR net of fees and expenses over a 3 to 5 year time horizon, or longer, particularly driven by EPS compounding, operating cash flow compounding of 20% plus. And this should also lead to healthy relative returns, because if the fund delivers 18 to 20% net of fees and expenses, then highly likely it would have outperformed Nifty over a 3, 5, 7 year period, because over longer term, Nifty we expect to deliver no more than, say, around 13 to 15% at best. Looking at performance in another way, this is a different sort of a chart which breaks the last 6 years, 5.5 to 6 years since inception period, into 3 parts. Phase 1 is the first 3 years after we launched. Very healthy absolute as well as relative returns. The 27% annualized versus 17% annualized for the index. A very good period for the portfolio performance. Phase 2, very painful 15-month period where not only did we have a weak absolute return of negative 14%, it was a very weak relative return as well. There were 3 reasons for it very quickly. Firstly, the definition of winners in the economic landscape, it has changed remarkably post-COVID. And we didn't catch that in our portfolio in the second phase. More on this aspect, which I'll be covering later on in this webinar, and how we've changed it in the third phase. The second factor of phase 2 weak performance was that our largest allocations, so for instance, HDFC Bank, Bajaj Finance, Page, Dr. Lal, etc., their valuations were at peak, and certain risks when they emerged on the horizon, as and when some of those risks started to play out, there were massive drawdowns or stagnation in the share prices of those companies. We fixed this aspect as well. It has been fixed in the third phase. And the third factor for the weak 15-month performance was something that we don't worry much about because it's unavoidable. So government capex oriented players and PSUs in the broader market, they did well. We were not exposed to these sectors, and we will not be exposed to these sectors under this philosophy. And that's just because we don't think fundamental compounding is very consistent in these parts of the stock market. So that's the third factor. When you come to phase 3, which is the last 1.5 years, the right-hand side set of 2 bars, the challenges that we were facing have started to reverse meaningfully, as I previously mentioned. The relative underperformance is not something, this 300 basis points that you see, bulk of it actually has gone away in this running month. This underperformance of phase 3 is not something that we are too worried about because we believe it's highly temporary, related to the factor around PSU banks and broader PSU stocks in the stock market. Going forward, if challenges akin to phase 2 hit us again, I think we are much better prepared to cushion the downside impact compared to what we saw here. Coming to the breakdown of this across stocks. So this is a sort of a waterfall chart or a stack chart attributing performance of CCP since inception across different stocks. All numbers here are annualized. So it all adds up to the annualized return since inception. This chart is gross of fees and expenses because we are trying to attribute across stocks. So fees cannot be attributed across a specific stock. A few observations. Observation number 1, very few stocks have contributed to negative returns here. And whatever negative returns, the last 4 stocks you see on top right, they are very small negatives, some of them very short time period as well. And that's a very good outcome to have, not too many negatives in the attribution chart like this. Second observation, stocks with healthy positive returns are not 3 or 4 in number, they are 10 to 11. So how do I say that? So think of it like this, largely this portfolio has had 14 to 15 stocks throughout its history. And if it has compounded 20% annualized, give or take, then across 14, 15 stocks, roughly 1.3% per stock is the rough maths that on average you would expect. Now, there are more than 10 stocks, if you count from left all the way to, say, an HDFC Bank or Nestle. There are around 10 stocks out of the 14, 15 that we've held for the longest period of time, which have all contributed to the above average return. And even the top stock is only twice the average rather than being 3, 4, 5 times the average. That's quite a fragmented outcome of positive returns across multiple stocks. I would have been worried had the positive stock contributions been 5, 6, 7% each across 3, 4 stocks, and that's it. It would have been more like a one-trick pony kind of a performance then. Third observation, actually, based on some client questions we got on this one-trick pony observation, one-trick pony piece. So if you plot the same chart over a 12-month period, there will be several 12-month periods where 1 or 2 stocks would contribute to half or more than half of the 12-month period return, right? So, so in FY21, it was Bajaj Finance and Asian Paints. FY22, it was Titan. FY24, it has been Trent, or the last 12 months, it has been Trent, so on and so forth. In a very concentrated portfolio where you're holding the top stocks as 9, 10, 11% allocations each. If the top stock does well, then I mean, 6, 8, 10 percentage point contribution over a 12-month period return can come from 1 or 2 stocks. So that's not something that is abnormal, unhealthy, or something that we should be concerned about. It's a recurring feature of a concentrated portfolio. Coming to the fundamental performance of CCP constituents, this is the table of the current portfolio. Again, two observations here. when you look at the columns on the right-hand side, the two columns titled Q1 FY25 YoY, revenue of CCP portfolio has grown in 1Q at 18%, compared to 9% revenue growth for the top 100 listed stocks in BSE 500. This I'm quoting from one of the sell side brokerage reports about how BSE 500 and the top 100 and the rest of the index did in 1Q. 1Q was pretty weak in terms of fundamental performance for the broader market, against 9% revenue for the benchmark in a way. I mean, I'm talking about top 100 stocks because that's the data that I spotted here. Against that, 18% is pretty healthy. Even healthier is the EPS comparison. So EPS of the top 100 stocks in 1Q went up by only 1%, whereas the EPS growth that you see for this portfolio weighted average is 23. Even on a median basis, it's 11. It's a pretty healthy. The 1% obviously is weighted average for the top 100. So very healthy absolute and relative returns sustaining. This is exactly the consistency of fundamentals that we aim to deliver in this portfolio. Second observation, when you note the reinvestment rate and return on capital employed columns for the last 5 years, there's a significant change worth spotting here. If you remember, those of you who've been following us, until about a year ago, the portfolio constituents used to have a weighted average reinvestment rate of around 50 to 60% and a return on capital employed on average of around 35 to 40%. Product of these two gives EPS growth, and hence we used to see 20% plus compounding in EPS of this portfolio. The run rate of EPS compounding has remained unchanged, but the constituents have modified a bit. So the reinvestment rates have rocketed up from 50-60% previously. It's now closer to 80%. And the return on capital employed from being 35-40%, it's down to mid-20s. Product still remains the same, which is the EPS growth of 20% plus. But worth noting that we are consciously and in a very relevant way for the current external environment, picking up companies which have very high degrees of reinvestment into non-core areas of business to keep the growth engine compounding in a much more sustainable way. And we'll discuss this in a minute as well. The rest of the slides deck that I'll just take you through is based on some feedback that we received from our business development team, sales team, channel partners, in terms of the frequently asked questions, given what CCP has gone through over the last 12 months around changes made to the portfolio. So I'll be covering why we've picked up more challenges, why the churn has increased, how do we see valuations, number of stocks in the portfolio, what does it mean to the concentrated aspect of this portfolio, and our buy-sell discipline, how has it delivered. So taking all of those elements one by one, first and foremost, why have we made these changes to the constituents around reinvestment rate and return on capital combination? In effect, if you've been following our newsletters as well, enterprising compounders rather than companies doing more of the same. So the way we see it, corporate regime in high quality compounders in India has changed quite drastically between pre-COVID and post-COVID. So 10 to 15 years prior to COVID, great companies, they kept doing more of the same in their core businesses in a better way progressively over time. That was really the definition. More of the same, better way over a period of time. Macro was not significantly adverse for most of these companies. Regulation was not very restrictive. Competition could not fast track their catch up with incumbent monopolies, and hence returns on capital employed of great businesses, they were very high, around 40% odd on average, as I said, and with only 50% reinvestment of capital, the rest of it being returned as dividends largely. with 50% reinvestment rates back into the core again and again over a period of time, there was healthy 20% plus EPS growth delivered by these companies. This is how the world of greatness, the way we perceive it, used to exist pre-COVID. Post-COVID, there's been a regime change. Macro has become far more difficult in pretty much all streams of industry. So, for instance, if you pick up today's Business Standard, there is an article right at the bottom which quantifies that ex-BFSI for some 800 plus stocks in the market that this Business Standard article has analyzed. There's hardly a 9% CAGR in capex against that 32% CAGR in EPS over the last 4 years, right? Quite a difficult kind of a situation it then creates if fixed assets are not getting added and EPS growth has been coming through. So a lot has changed in the pre-COVID to post-COVID in that regard. Interestingly, the regulatory environment has also become very tough, particularly for financials. Competitive intensity has literally skyrocketed upwards because GST, India Stack, Aadhaar+++, and the physical and digital infrastructure that this country has seen develop over the last 5, 6, 7 years, it has allowed competitors to catch up with incumbents at a much faster pace than they previously used to, right? A combination of all these factors means that amongst the larger companies in India, greatness defined by, let's say, high and sustainable EPS growth today doesn't belong to companies that just do more of the same in a better way. It actually belongs to companies that allocate their core cash flows very rapidly to develop challenger businesses beyond their core, right? As a result, higher reinvestment rates with maybe a little lower ROCs is a combination that many companies will find more sustainable to deliver earnings growth of 20% plus, given the regulatory environment, given the competitive landscape, given the macro, so on and so forth. Now, this exactly then is the pivot that we've made in our stock selection. So, for instance, businesses like Tube, Trent, Narayana Hrudayalaya, Eicher, Escorts, Tata Consumer, Metro Brands. These are the stocks that we've added. They've been known for several years as good companies. Their share prices have already compounded at a healthy pace in the past, but we bought them today rather than previously because a Tube of today is very different from what it was till 4 years ago. Narayana of today is very different from what it used to be till 3, 4 years ago, so on and so forth, and likewise for all the other additions to the portfolio. And you see several challenger type of businesses as a result also being in this list rather than just pure play incumbent monopolies in whatever they do, which then brings us to the second question. We've had a massive churn in the portfolio. CCP has had more than 50% churn in the last 12 months. And I'm sure the justified question then is what happened to long holding periods here? Because we had been communicating about low churn, long holding periods, no more than, say, 15% odd portfolio turnover, so on and so forth. Well, the first piece, the churn that you've seen in the last 12 months, it relates to the pivot in the stock selection that I highlighted, that we've done to bring in more challenges. Hence, this part is a one-off, quite clearly. And hence, going forward, average expected churn from this portfolio we see being around 18 to 20%, which is 3 to 5 percentage points higher than what we used to previously guide. And there's a reason for that 3 to 5% higher expectation, because within the 18 to 20%, what remains unchanged is roughly 10% churn annually in future likely to come from stock selection. But rather than just 4 to 5% coming from position sizing, we expect 8 to 10% coming from position sizing. And hence, you might actually in future see a far greater position sizing related contribution in the portfolio, which also becomes an outcome of a slightly longer list of stocks that we currently have in the portfolio. The next question that I want to address that we keep getting asked is, has anything changed around our approach towards valuations? So yes, there has been a change till November 22. Those of you who've been investors for long with us, till November 22, you might remember, we used to position size based largely on the quality of the business, measured by longevity scores and expected earnings growth. That's it, right? In November 22, we toggled over to something called margin of safety and sustainability. We used to call it MOS. In effect, rather than purely on quality position sizing the portfolio, we started to position size basis the gap between fair value and current share price, with the fair value capturing elements of quality and the current share price capturing elements of valuation. That was the pivot we made about 2 years ago. What we have changed in the last, say, 8 to 10 months is that we've moved to something called, we internally call it as an expected IRR approach, being cognizant of not just the long term, which might be very good for all the businesses over time periods as long as 10, 15 years or longer, but also being cognizant of risks on the horizon that if play out over a 3, 4, 5-year period, then can that throw up an opportunity for us to benefit from via position sizing, right? So to that extent, position sizing will factor in risks of derating and in some cases even risks of re-rating. So there are a couple of stocks we recently added where we see massive upside risk of re-rating. So rather than just position size basis EPS, CAGR and the quality of the franchise, a lot which is not in the franchise is price at the moment, in the stock's price at the moment. We want to benefit from that. So those opportunities of position sizing with a 3 to 5 year time horizon of derating and re-rating in the price to earnings, price to book, price to cash flow multiples is also something we've started to capture. For the current portfolio, just to summarize the outcome of this IRR piece in a nutshell, our base case expected EPS CAGR on a weighted average basis for the next 5 years is around 23%. Cash yield on top is another 1 percentage point odd. And net of PED rating, we expect say around a little over 20 in terms of the IRR. In the worst case scenario where you might actually see, let's say 40-50% derating in the PE multiple of the portfolio, this IRR drops down to mid to high teens, around 17-18%, 17.5%. This is all gross of fees and expenses, obviously. So that's the way we are approaching things. But these are all guidelines, not really the forecasts of the portfolio as we go along. Currently, the PE multiple of this portfolio on FY25 earnings is 56 times. That's a 6-month forward PE multiple. And FY26, which is 1.5 year forward PE, it's at 44 times. Obviously, both of these numbers are boosted by Trent's PE in it, which is also one of the largest weights. But then Trent is also a very interesting exception, which I can cover later on if the need arises. Next question that I thought we'll preempt and answer: is this still a concentrated portfolio? So simple quantified ways to answer it. More than 45% of the portfolio allocation is across 5 stocks today. This number used to be 49% till a year ago. More than 70% of the portfolio allocation is in the top 10 stocks today. This number used to be 78% till a year ago. So not much has changed. Not much has changed in terms of concentration of allocation across the top 5 and top 10 stocks. What has changed is there's a significant increase in the width of sectoral exposure within the top 5, 10, and the entire portfolio. Rather than being just exposed to consumption, home building materials, financial services, and maybe a little bit of healthcare the way we used to be previously. There's a lot of allocation to private capex, to exports, to rural rural aspects of the industry, pharma, etc., which are the newer areas getting added. Reduces the correlation of fundamentals and share prices as a result within the portfolio, the true diversification benefits without changing the concentration of the portfolio. And also a little longer list of stocks with relatively smaller allocations is where I previously mentioned the pivot on an ongoing basis we'll make around position sizing to bring in extra contribution from position sizing is oriented towards. Last question I want to preempt and address is about the selling and buying discipline. Now, first and foremost, so in effect, do we sell just before the rally, as in sell too soon, and do we buy too late or just after the rally? There's some interesting data points worth considering here. So the table on the right shows you the hit rate of position sizing since inception, where this table summarizes only position sizing changes above 2.5 percentage point quantum of one decision. But the average that I've given in the first bullet on the left is for all kinds of position sizing above 1% allocation change. It's approximately 75% hit rate, which is actually quite remarkable. Even we were quite surprised at how big this number is. 75% hit rate, where only a quarter of the position sizing changes weighted by allocations have gone against us. The big ones that have gone against us are the top four that you see, the orange shaded, the ITC exit, which was done at 208 rupees, for instance, the Abbott exit, complete exit, ICICI Lombard trimming that we did at roughly half the price of current price, Trend trimming that we did about a couple of months ago. Trend trimming actually is a far more risk-oriented call that we took. Otherwise, Trend would have become too big in our portfolio for us to be comfortable with. So that's a little different type of orange. But the first three are clearly the misses, but the hits are too many. And I don't need to go through the list. You can see it. And the hit rate is what I mean. There's a science to it. The way we've ended up benefiting, and hence the aim that going forward we intend to bring in position sizing related contribution to portfolio performance in a far greater way in this portfolio. FY25 so far, it's a very short period of time, 5 months hardly. Hit rate is 50-50, give or take. There are you can say misses. We kept trimming page right from 35,000 to 42,000 as it kept going up a little bit every time. Dr. Lal likewise, Kotak HDFC Life we trimmed before their share prices stabilized at higher levels. BAF, we did a little bit of trimming, but these are the small negatives, very short period of time, as I said. More than compensated already by Tube, Chola, Metro, Astral trimming, Alchem buying, barring Astral, everything else is a buying in that list, etc. So beyond the hit rate, current portfolio is also an upgrade versus how it stood 6 months ago, which is a separate dimension worth bearing in mind. It's not just the hit rate compared to where this portfolio used to stand 8 to 10 months ago. Given the external environment, at the same time, relatively narrower exposure to the number of sectors. A lot of work has gone in from the research team, from the fund management team, IC, etc., in bringing about the width, bringing about incremental depth rather than compromising on depth in any way, and hence a much better portfolio, I would say, as a fund manager when I see today's portfolio versus 12 months ago. So hit rate has been pretty good and comfortable there. Performance comparison is a very good way to understand that in terms of unchanged portfolio versus the real. If you want to summarize all the hit rates, let's say. So for any date you pick up, I've picked up 31st July because the real churn of the last 12, 13 months started in the month of August last year. So if you pick up 31st July 2023 portfolio, leave it unchanged, untouched, let the winners compound, let the losers go down on their own, and no rebalancing whatsoever. That 31st July portfolio would have delivered 16.5% versus the actual CCP return net of fees and expenses of 21 plus till 31st August 24. Add back the fees piece and hence a good sort of 6-7% alpha through the changes that we've already made here. So pretty comfortable on that count. This slide, lastly, is just summarizing all the changes that we've made. So starting from the 12 o'clock position of both the charts when looked together, as in the one on the left in terms of what has changed and one on the right in terms of what hasn't changed in CCP. Width has certainly changed, but depth hasn't. So that's one piece. When it comes to picking up companies with great historical fundamentals, the core of the companies in our current portfolio have been as long-term, healthy historical fundamentals as we used to previously. So, for instance, if you pick up, let's say the Metro shoes or the Tube Investments or the Trent West Side business, which are all the core parts. The core of these businesses has had 10, 15, 20 long years of healthy rate of revenue growth, ROCs pretty consistently. What has changed is we are catching early the creation of non-core businesses, as we call them, challenger stage, rather than picking up a trend only after Star Bazaar has become a consistent compounder in itself. We'll not wait for that. We'll not wait for a Tube to see its all non-OEM, auto OEM manufacturing businesses to become great by themselves. We won't wait for Narayana to build their integrated business model and make it great before we buy it, so on and so forth, right? So that's the piece of catch them early compared to consistent compounding of healthy fundamentals previously. In terms of moats and returns on capital employed, the only thing that has changed is the energy that we seek in capital allocation decisions. Otherwise, returns on capital employed have to be high, healthy through deep-rooted moats. In terms of churn, as I said, last 12 months was a one-off. But going forward, instead of say around 15% previously expected churn, we continue to expect no more than 18 to 20 going forward. And within that, very active use of position sizing to our advantage. Portfolio concentration, uncorrelation of risks is certainly a change, but otherwise the portfolio is very concentrated. Valuation I talked about, and hence, largely speaking, I would say these are the sort of upgrades that we have made over the last 12 months. So I'll stop there. We might still not have answered too many of your questions after preempting many of them. So I'll just turn the camera around and we can take some questions.
Great. Thanks, Rakshit. I think you've already answered quite a few questions in the question queue. But for folks who still haven't entered their questions, feel free to put them in the Q&A box. Like I said, we'll try and take as many of them as possible. I'd like to begin with this very interesting question that the gentleman has asked is, how do we ensure that phase 2 in our journey doesn't repeat again? He's elaborated about, look, Fed rates thing is happening again, US elections and all. Before you answer about how you're looking at it as a portfolio manager, I'd like to point out to this gentleman and others, if the Federal Reserve rate cuts are coming through, this is almost the exact opposite of phase 2. Remember, phase 2 was all about Federal Reserve increasing interest rates by almost 500 basis points. So 5 percentage points in a span of 15 months, which is the fastest and sharpest rise in interest rates the world has seen in 40 years. So this was an exceptional period. If at all, the ensuing 12 months, we are not macro experts. We don't know. Looks like the probability of a rate cut later this month is pretty high. Looking at the surveys, looks like we're headed towards a 2.5% sort of a rate by the end of next calendar year. So that's going to be a sharp rate cut cycle as well. To the extent that rate hikes affected a quality growth portfolio, which is understandable, rate cuts presumably should benefit. Having said that, we are not managing the portfolio basis our expectations that rate cuts will benefit. I'm only trying to share the historical correlation. But other certain factors that affected phase two, I'll request Rakshit to throw some light as to how we're going to avoid a phase two again.
Sure. No, thanks, Pramod, for that macro piece. So, as I mentioned, there were three contributing factors. One of which we haven't changed, which is that if there's a 15-month period where in the broader market, a segment of the stock market which we don't think is consistent compounding of fundamentals, and that segment does extremely well compared to the rest of the quality universe, then the drag created by that on a quality portfolio is something that I don't think we can avoid. This is something which has actually persisted even in phase three. So the PSU rally of various types of PSUs, it was not too different. Obviously, the names of the stocks differed in terms of phase 2 PSUs and phase 3 PSUs in some ways, but phase 3 was equally intense in terms of the kind of stocks that contributed to the 31.94% of Nifty, which we didn't own, and our 28.62 didn't come as a part of the subset of the winners of the broader market. Despite that, we delivered 28.62. So that's the one piece which we wouldn't have changed in phase 2. This piece would have provided whatever drag on relative returns basis, not on absolute returns really, in a meaningful way, right? So that's one factor which hasn't changed. But there are two other things which have changed, as I mentioned. One is the way we bake in position sizing for companies which are large allocations with risks on the horizon. So I'll give maybe two contrasting examples. When you look at a Divi's Lab versus any of these HDFC, BAF, Page Industries, or Dr. Lal, let's say, right, the four that I mentioned. When you compare these four against Divi's Lab, we did something to Divi's Lab which we should have done to these four as well. What did we do to Divi's Lab? So if you go to, I don't know if that table captures it. Let me just check. Yeah, if you go here, table on the bottom right, we trimmed Divi's Labs to half of its position in June 21, right? This 3% selling that we did. Why did we do it? We did it because it had run up a lot, and to be honest, we needed to make some space for other stocks. The valuations here were already looking pretty punchy, but we didn't do it as a process which would have applied to maybe a few other stocks as well. And then we doubled Divi's. We doubled Divi's in October 22, right, at around 3,400. We bought more of it, I remember, which is not part of this table because it was less than 2.5%, somewhere in February 23 at around 2,900. So those were the changes that we did. And hence, despite Divi's giving a bigger drawdown than a Page to our portfolio, despite Divi's giving a far greater pain as a share price to the portfolio compared to, say, HDFC Bank or Dr. Lal, Divi's ended up being one of the biggest contributors to our performance over the last 3 years, right? Through this position sizing change. Obviously, today the share price is some 5,200 or 5,300, and it is continuing to be a large allocation in our portfolio. Now, this piece is something that we should have done to an HDFC Bank when we saw the regulatory risks emerge on the horizon. That's a corrective action that we started to take in the last 10 months on HDFC Bank, likewise on, say, a Bajaj Finance, when we can see which color of financial services companies is coming under what kind of external headwinds. There are lots of dots that we could have joined a year and a half earlier. And if we had joined them and done to the position size of a Bajaj Finance or an HDFC Bank what we did to Divi's, I think we would have been much better off. And the third part is a little bit of width in the portfolio would have maybe reduced the correlation of risks. So our portfolio ended up being a significant beneficiary of companies that handled logistics very well during the COVID crisis. In fact, they benefited massively. There were very few B2B companies. There were very few, let's say, private capex-oriented companies, so on and so forth. There was no pharma. So to that extent, we could have had a little wider net. It would have maybe added 1 to 2 percentage points. Net, had we done this, to be very honest, even after having made the changes that I talked about, realistically speaking, not theoretically speaking, theoretically we could have brought the best performing charts out here, but I'm talking more practically. Instead of a minus 14%, I think we could have had a -6 or a -4, or maybe -2 at best. We could not have avoided the underperformance of phase 2, but we could have cushioned the drawdown by, let's say, 6-8 percentage points, if not a little more than that. And that cushioning of the drawdown is something that would have, even to investors who started investing with us, let's say, 3 years ago, they would have had a double-digit rate of compounding instead of 7% that they saw. Barring that, I think when quality was under the pump for reasons that Pramod mentioned, or for relative reasons compared to what was working in the market prior to 4th of June 2024, I think there are relatively limited pieces that we could have done to try and outperform in phase 2, but we could have been much better than what we were.
Great. So this is another interesting question. You've been co-author of Coffee Can Investing. So two people have asked the same question in slightly different ways. One is fairly straightforward question: is the Coffee Can portfolio or the style of investing dead in this major reset? Another gentleman has, I'll pretty much say it verbatim. Rob Kirby's CCP observations, as taken from one of Marcellus' newsletters, highlighted the efficacy of holding on to original ideas and not changing it with the flow of times. I'm just curious about the same with regards to the CCP portfolio. What would have happened if the CCP portfolio was left unchanged since inception?
Yeah, no, this is an easy one to answer. I answered the 1 year time period. Since inception, it would have been far lower than what we delivered. The 1 year answer to the last question of what would have happened had we left the portfolio unchanged. The one year answer is in the bullet and on the bottom left. The 5 year answer is something very similar. It's not 7 percentage point weaker performance. It's about 3 percentage point weaker performance in the portfolio. Had we left it untouched 5 years ago, we would have had a much weaker outcome. I mean, I can just rattle off names. So for instance, what position sizing has done to us is about 200 to 220 basis points since inception, positive contribution, which an untouched portfolio to begin with would not have had. Right? That's point number one. Point number two, we made changes where, let's say, particularly everything that we did in the last 12 months in terms of changes has added a positive 6 to 7 percentage points to the portfolio. That piece wouldn't have come. Annualize that over a 5-6 year period, you get somewhere between 1-1.5% annualized contribution, etc. And then there are a few other elements. So net, I mean, we do this in our monthly business reviews, which have certain metrics that we track for all the funds. It would have been much worse off now had we not made any changes to the portfolio. Now, answering the previous question, so is coffee can investing dead. Let me put it this way. When we published that book, it was a DIY approach, which we did not follow right from the day we started managing CCP, either in our current avatar at Marcellus or in the previous avatar where we were before this. The book mentioned you buy a portfolio and leave it completely untouched, equal weighted. We never ran CCP in the 6 years at Marcellus and 2 years prior to that, the 7-8 year of fund management journey that I've had, for instance. We never ran CCP as a equal weighted portfolio at start, left untouched throughout. So right from the beginning, we had deviated from the book intentionally, because book was for a DIY investor with a time horizon of 10 years only, pretty much, right? It was not catering to 3 to 5 years time horizons as well. And it was not trying to add alpha on top of the benefits of coffee can investing. Have we added alpha? I answered it. What are the evolutionary changes? Well, if you notice, even within the book, prior to year 2000, the coffee can investing approach would not have worked in India. They weren't companies which delivered longer than 10 years of return on capital employed and revenue growth of higher than those benchmarks, right? When we built the coffee can investing portfolios, there were barely 5 companies in the first 3 or 4 iterations. Those of you who've read the coffee can investing book. We never want to run portfolios with only 5 stocks or 4 stocks in it. So when the external environment changes, and let's put it this way also, the moment COVID happened, there was no company left with 10 out of 10 years of consistency in revenue growth and return on capital employed, because COVID was a blip for any type of great business operating in India in terms of its fundamentals. So once you bake in that blip, well, in any case, the purity of the book, it goes away. Having said that, if you look at the churn in this portfolio, including the last 12 months of churn, it has been around 18, 19, 20% roughly, because it used to be 12 to 13% annualized till mid 2022. Then there was zero churn for 12 months, and then there has been this 50%. So net, the churn is still reflective of 6 years, give or take, being the average holding period, 5.5 years being the average holding period of stocks ever since we've been managing this. It is a long holding period approach. We are buying companies based on fundamentals, which are all the elements of coffee can investing. We are buying companies which have already proven themselves in the past, and then we are letting the winners run to an extent, and then also icing on the cake through position sizing. So yes, we are not following the book, but we were never following the book at any point over the last 6-7 years in a pure way. But to me, this remains a portfolio which sticks to the definition on the inaugural slide, which is a concentrated portfolio of heavily moated companies that can drive healthy earnings growth over long periods of time. Those are the 4 attributes. We stick to that.
Yeah, I'd like to just add to what Rakshit said. In fact, in the book, he's shown that several of those sort of algorithmically created portfolios were actually quite volatile, even in the short run, right? Correct me if I'm wrong, yeah. Rakshit, I remember that chart you had, which showed while over a 10-year period, you get healthy compounding, in between, even those portfolios were extremely volatile.
And you had to merge 10 such iterations to lower down the volatility.
Correct.
The portfolio, Pramod, you might remember, 2016 portfolio full of housing finance companies.
Correct.
Buy and hold today, it would have probably not even met cost of capital.
Correct. So the only way perhaps buy and hold works is where you lock up the capital. Remember, the coffee can concept was about locking up your share certificates in coffee can. For the gentleman who sort of invoked Rob Kirby, Rob Kirby's true story was about a client who died, who did not touch his portfolio. So whichever way you look at it, buy and hold works where you can fathom short-term volatility, which is inevitable. But in reality, most of us human beings cannot handle that volatility, and hence the need to be more dynamic and agile in that. But like Rakshit reiterated, the characteristics or the traits of those companies, that is still intact in consistent compounders. And as you can see on the screen, and Rakshit just rightly pointed out. Now, coming to another aspect of our change, we talk about being more valuation agnostic. Somebody's asked the question that, look, 56 times earnings is not particularly being valuation agnostic. We understand a lot of it is pulled up by trend. Now, the simple question this gentleman is asking is, if you leave out trend, where does the PE of the portfolio stand today? I have a follow-up on PE, which I'll ask.
Yeah, so the best way to do that maths is you assume that Trent was also a 50 times PE rather than 120 on FY25, and assume it was a 40 times FY26 PE rather than I think 80 or 75 that it is on FY26. So if you make those changes, the weighted average then drops down to 50, roughly 51 times for FY25 and about 38, 39 times on FY26.
Right. Now, the follow-up question on PE is, across our portfolio, we are saying that most of the returns will be driven by earnings growth. In fact, we are factoring in an element of PE derating. Can't we build more margin of safety in terms of picking up stocks where there is no scope for PE derating?
Yeah, no, we are trying our best. Let me put it this way. I'm going to quantify a few things. Internally, the number of stocks under our quality universe that we cover today across our research team is roughly twice of what it used to be till 2.5, 3 years ago. So a lot of work has gone into identifying, as I said, including the challenges as well in the list, and hence building depth with width, not just depth. We've picked up some of those in the portfolio. Interestingly, we do have one company which is less than 20 times PE, non-financials company which is less than 20 times PE in our portfolio. We've got a couple of them non-financials which are less than 30 times PE in the portfolio. Well, when I say non-financial, non-lending, because lending PEs obviously will be lower. So we've got some of those picked up. Yeah, I mean, what we are consciously doing is, wherever the PE multiples are 70, 80 times, for reasons not similar to the reason that applies to trend, then we are trimming allocations very aggressively, very meaningfully, to bring it down to a lower level and leaving room for a jack up. So Titan is a great example. For instance, we bought it at around 55 times. Now 55 times you can say is also pretty expensive, but not really when we see how Titan adds value, what is baked into the earnings and what is not. It wasn't an expensive entry. It went up to all the way to 75. We trimmed the position down to less than half. So far, we've been rewarded in the last 6 months for that trimming, and we'll see what needs to be done if the P multiple corrects for Titan. So so we are trying our best. It's not that there aren't options. There are some of those, but at the same time, what we won't do, let me be very clear, is we won't compromise on quality of the companies in exchange for valuations. Remember, it is not so much purely the valuation that hit us in phase 2, because many of the companies which did well, Titan is a great example. It helped us in phase 2 despite being a 70 times PE company, right? Multiple. Trent is another one. We didn't have it really in phase 2, but during phase 2, a stock like Trent, it did exceptionally well despite being 100 times plus, etc. So it's not just the valuation; it's the play out of risks on the horizon with high valuations. That combination we are trying to manage better. So yeah, we'll keep trying, but we'll not compromise on quality of the fundamentals in exchange for just a low PE.
Fair enough. So one sort of side effect of this shift from buy and hold to a little more agile, dynamic has been the higher churn, and the valid concern has been the churn results in Of course, transaction costs, some of which gets reflected in your NAV and performance, but the taxation piece obviously doesn't get reflected in your net of fees, net of transaction cost performance. How should we expect? You mentioned that some of the churn that's happened over the last 12 months is a bit of a reset. It's unlikely to sustain. From a going forward perspective, how should we expect churn ratios compared to our historical average compared to the last 12 months?
Yeah, no, that's a very valid question. So, because I've paid tax on my own account as well, and it wasn't a small number compared to what usually I pay on my account. So here is a simple way to look at the maths. Let's say we're talking about the portfolio delivering 20% gross return, gross of taxes. I mean, I'm using 20 only as an example to make it a simple round off number. On a 20% NAV CAGR gross of tax, if let's say you were to book the entirety of the profit on the 366th day, as in 1 year and 1 day, and reinvest it back into the portfolio, then over, let's say, a 10-year period, your 20% gross of tax comes down to 18% net of tax, assuming 10% tax rate. I know the tax rate has become 12.5. So again, I'm using a round off number to just give a broad sense of the answer. So if you apply a 10% long-term capital gains tax, and assuming all the taxes are long-term, because in this portfolio, even though the churn has happened and taxes have been paid by all the clients, it's largely all long-term tax rates, right? So assuming 10%, the 20 gross becomes 18 net if you sell everything in 1 year, 1 day and reinvest it back. If you don't sell anything and you sell all the gains, book all the gains at the end of the 10th year, then if you do a simple Excel sheet calculation, the 20 gross becomes 19.2 net, because you're compounding the tax liability before you give it to the government, and you're retaining a part of that compounding when you give it to the government, right? So your 20 gross becomes 19.2 net instead of becoming 18 net. Now, between the 15% previously expected run rate and ongoing run rate of churn and the 20% expected ongoing run rate of churn, we are talking of the 15% churn going to 20, leading to the average holding period of a stock reducing from, let's say, 7 years to 5.5 years, or 6.5 years to 5.5 years, something like that, right? So that makes hardly a 10 basis points change to the net of tax return. So instead of it being 18.9, it will become 18.8 in that scenario of 20 gross, 10% run rate of capital gains tax on long term. So the 18.9 might become 18.8. That's what has changed with a little bit of churn. But it is not that we will be making you liable as a client with a lot of short-term tax going forward, or the holding period from 6.5 years has dropped down to 2 years or 3 years, and hence there's a big 0.5 percentage point delta between net of tax previously versus net of tax now. None of that, right? So that's the simple way to quantify it.
Fair enough. So there's a question on the concentrated returns in the portfolio. Clearly, Trent has delivered a lot of the returns. So clearly, I mean, this is the contribution from inception.
Yeah.
Trent being in the portfolio for barely a year and a half has contributed massively. That means the last 1 year or 6-month alpha, Trent should have driven a lot of that alpha. If you leave Trent out, what would have been the performance of the portfolio?
Yeah.
And secondly, specific to Trent, given that it's a top holding in the portfolio, and from a valuation perspective and recent performance suggests that it's done phenomenally well, what are the risks of some of that good performance or good contribution unwinding?
Right. Two very valid questions. So the contribution of Trent to this portfolio has been around 9% in the last 12 months. Why 9%? Because initially we bought it as a 3% allocation, then we increased it to 6. On the 6% allocation, not all of it has trebled on us. We did some shaving off as well, which I talked about at around 5,000. So there's our last 12 months performance of the portfolio, or in fact, ever since we added Trend to the portfolio, it's largely the phase 3 return because Trend was added in the month of August. So the return, even if you exclude April, May, June of last year, it's about 23-24% absolute. Out of 23-24, Trend has been 9.5, 10, somewhere around that. So it's about 40% of the return for the last 12 months. Now, this is not the first time. I remember FY23 performance would have been 8 percentage points lower had there not been Titan in it, because Titan was a 9-10% allocation and it doubled on us from, I think our entry itself was a 8-9% allocation at 1,700 rupees a share, 1,800 rupees a share or something like that. And then it went all the way up to above 3,000. So Titan contributed equally heavily. I remember FY21, because of the position sizing change that we made to Bajaj Finance during COVID and the large allocation that we in any case had on Bajaj Finance. Bajaj Finance was more than a third and Asian Paints was another third. So Asian and Bajaj, just two stocks contributed to 60%, 70% of the return in FY21. So this is a phenomenon that in a concentrated portfolio you'll see occurring over shorter periods of time. And I mean, the best way to understand it is it's such a concentrated portfolio that every 3 months we'll have only 1 or 2 stocks driving half of the return. I mean, for instance, this month it's all Divi's Lab or Narayana and Divi's put together have driven this month's last 10 days or whatever. So shorter the time period, the more the allocation from 1 or 2 stocks. And hence what Trent has done to the portfolio is not something that we've not seen in the past, and we'll keep seeing it in future as well. Now, coming to that second question then, what happens to the risk of Trent reversing on us from here? So, I mean, we are very, very conscious of this. In fact, one of the highest run rates of channel checks that we've been doing in the last 6 months, ever since the share price ran up so much, was on this stock, especially to ensure that this risk doesn't play out in us. It is natural as well for every large allocation. So for instance, for Narayana, for Tube, the number of channel checks that we keep doing are far more than average. We do see, without going into too much details, we do see a lot of undervaluation from Star Bazaar in expected fundamentals for consensus, for sell side numbers. A lot of positive surprise coming up there. Those of you who are either in Telangana, Maharashtra, or Karnataka, the 3 states where Star Bazaar is present, barring viewers from these 3 states, others won't be able to relate to how powerful an engine Star Bazaar has become. It's a hands down victory over a format which is the largest listed grocery retailer in this country. It's a hands down greater value add through fresh foods and vegetables, which derives a very healthy gross margin. I won't quantify, and it's the powerhouse of footfalls, revenue, profitability of the entire franchise. It's just a matter of time before when Star Bazaar gets scaled up. So that's a very big part of undervaluation that we see. Once that has played out, once that has been baked into the valuation, not really delivered in the numbers, because many times market factors in the future sooner than the future plays out, we'll be taking the corrective action. But not at the moment. At the moment, the rate of earnings that we expect to see a Trend deliver over the next 2-3 years, basis our understanding, and we might go wrong, but we are very highly convinced about it, that the rate will be very high. So yes, there is a risk. The moment we see signs of that risk playing out, we haven't forgotten, as I mentioned, the impact of risks playing out on highly valued stocks of Bajaj Finance and HDFC Bank and Divi's and not Divi's, sorry, Page and Dr. Lal, so on and so forth. We'll take corrective action.
Fair enough. So there's another question about the change in the portfolio approach, right? This whole challengers thing or enterprising compounders thing. Again, I'll do this verbatim. Now that you've increased exposure to catch them early companies versus consistent and healthy historical fundamentals companies, do you expect the volatility in the earnings of the portfolio, therefore the stock price performance to increase compared to the historical past?
Yes, but at the same time, the longer list helps reduce that volatility. Also, the uncorrelated exposures in terms of sectors in the portfolio reduces that volatility at a blended weighted average level. So when you combine these two elements, they more than neutralize each other. In fact, net of the diversification benefits of not just a slightly longer list of stocks, but more importantly, the lack of correlation in terms of sectoral exposure, which is number of sectors has actually doubled. The volatility at a stock level, answer is bit yes, but across the portfolio, no. Now, last piece, if we are right, more often than not, this volatility will be upside volatility than downside volatility, right? So the fact that you've got a strong core protects the downside of a tube, of a Narayana, of a trend. West side protects the downside of trends, earnings growth, right? Share price is a separate thing. P multiple, that's a separate concern. But I think the question is about volatility of fundamentals. Fundamentals of trend, the downside is protected by West side. If Zudio and Star deliver as challenger businesses, then it gives more upside volatility than downside volatility, right? So combine all of that together. As I said, I'm far more comfortable with this portfolio than I was with the portfolio that existed 12 months ago.
Right. So there's another aspect of the portfolio construction. Several people have asked this question, that there are quite a few small positions, or as one gentleman has mentioned, teaser positions in the portfolio, which is very unlike our historical past, where minimum positions were at least 3%, if not larger. Is this a conscious ploy? What is the thinking behind this approach of having, say, CMS, Berger, iShares, Alchem, and all these at suboptimal positions?
Yeah, Berger is not in it. Berger is out of the portfolio, but CMS, Alchem, etc. I agree. So yes, it is conscious, intended to provide two benefits. One, if the challenger piece is something that we are more convinced about for the top 5 or top 10, then the challenger piece of the bottom 6, 7, 8 stocks is where smaller allocation, it helps us handle that risk. The second piece is, which is the most important piece, it is that it's very difficult to play position sizes in a 3-stock or a 5-stock portfolio. And it is very difficult to play position size in a 50 or a 70 stock portfolio, right? If we've got 4, 5, 6 stocks, which are small allocations for a reason, and the reason could be high valuations, risk on the horizon. We are yet to build conviction on the challenger part of the business, so on and so forth. If some of those reasons are leading to the lower allocations, then the way these risks play out in our understanding gives us a massive opportunity to position size up and down across the portfolio for these companies in a very meaningful way. So those are the real rationales. But at the same time, let me just remind the person asking this question that it isn't such a big change. I mean, we always had 14, 15 stocks in the portfolio. We've got 19 today. We are not taking this up to 30 stocks. This is what it is, 18, 20, give or take. And concentration remains. So things have changed on the margin in terms of 1 or 2 extra stocks with low allocations. Nothing has changed materially.
Great. I think you've addressed this question partly in your initial comments, but just to delve on it a bit deeper, we've seen in several stocks, without getting into specific stocks, can you answer this question about, say, Page, Bajaj Finance, HDFC Life, Kotak, where we've been through a period of pain, and after that, we've sort of reduced the position or exited. Is there a sense of exiting on fear? There's a separate question. Are these companies no longer consistent compounders? Two different questions. But yeah, I think the first question is pertinent.
Yeah, so this is exactly why, I mean, we preempted this. This is exactly why we brought up this table on the bottom right. We have had those kinds of exits in the past as well. So ITC, Abbott, and the trimming of ICICI Lombard, the 3 examples in the top 3 rows, are also reasons for this. ITC actually happened 5 years ago. So in a way, we've been making some of these misses every once in a while, not just the Kotak, HDFC Life, etc. in the more recent past. And that's just because our hit rate is not 100%. Our hit rate is 75%, which is not a very small number, but it is not 100%. So you will always find 10, 20, 25% position size changes that didn't work our way, right? And since it's a concentrated portfolio, many of these will tend to be trimmings or exits more often than not, right? So that's one piece, one way to answer the question. The other piece is, yes, it would have been ideal if we had latched on to the energized compounders, you call it, or challengers, you call it, or I mean, it's one and the same thing. If we had latched on to that 12 months earlier, yes, it would have been better had we trimmed Bajaj Finance and HDFC Bank the first time their product was put on ban, and the first time that there was some announcement related to the chairman or or the promoter or the CEO or someone else. We should have joined the dots better, sooner. We should have taken some of those calls earlier. So yeah, I mean, in hindsight, obviously, which is 2020, we should have done things differently. Having said that, there's also a lot of it which is substitution. Every exit or trimming that we have done has also been substituted by something. If the substitute has delivered well enough, in some cases even better. So think about it. The entirety of Kotak exit went into Chola. For those of you who are our clients, you can see Kotak exit and Chola entry being 2 days apart. Chola has done better than Kotak from that share price level onwards, right? So that's one. Secondly, today on Kotak versus today on Chola, our conviction levels are markedly different. So it's not just about the share price, right? I mean, obviously, share price is, as many of our clients tell us, फंडामेंटल से पेट नहीं भरता है, शेयर प्राइस से पेट भरता है, शेयर प्राइस से पेट जरूर भरता है, but at a point in time when you're holding on to a Chola versus Kotak as a call in your portfolio, you've got to be convinced about the next 3, 5, 7 year prospects being superior for the choice that you made to be included in the portfolio. So it's a substitute to be brought in, which is the reason. Many at times a substitute does better or at least the same, which is why the hit rate is pretty high despite a few misses. And I would say, yes, linking it to the last part of the question, we do believe that our current portfolio is better in terms of consistent compounding of fundamentals than the ones that we've exited and the stocks that we've exited from. So, yes.
Right. So another trend is the competitive threats. Naturally, you buy great franchises which make a lot of money. They are always subject to competitive entry. Nobody likes to enter an industry where the market leader himself doesn't make money. So most of CCP companies have continuously faced competitive threats. Is there any sort of evidence or demonstration, much like you say, we'll try and be ahead of the curve on regulatory changes, management changes, or such risks? Is there any evidence to show that we are reflecting competitive threats more dynamically ahead of its impact on the earnings of the company?
Yes, there are quite a few. So if I pick up this table itself, going from bottom and upwards. So Titan, the reason we trimmed at that time was because of two reasons. Both were different sorts of competition. One was gold price had shot up really, and last we had learned about the impact of sudden spike upwards in gold price 2012, 13, 14, I remember. It had led to competition intensifying because a lot of competitors in jewelry, they buy the inventory of the commodity before they sell it to the customer. And hence they typically sit on massive inventory gains, mark to market, when the gold price rallies upwards. And they try to pass on some of those gains to the customer through price wars, which is something that we had been seeing from many large unlisted jewelry chains as well in the last 6-8 months. We anticipated this, and gold price really shot up in Jan and Feb by about 20-25%, I remember. And we thought that the risk might play out. It did, although these are temporary risks. So we would have loved it had Titan corrected down to 2,500 rupees. We would have then increased the position size as well. But unfortunately, it didn't correct. But at least it has been amongst the stagnant share prices for the last 6-8 months, and etc. So that's one. The second piece was the lab-grown diamonds was becoming a bigger and bigger risk. In the month of December, natural diamond prices fell by 30%, right? Obviously, today, again, hindsight is 2020. Now we see that natural diamond players have started to sort of push the lab-grown diamond industry out, even in the developed world beyond wedding rings in the US, etc. But at that time, it was a massive risk emerging on the horizon. And Titan here sitting at 75 times price to earnings, we didn't want to play that risk. And hence the halving, the trimming of the allocation. So that's one example. Then there are a few others as well, far more recent trimming that we've been doing. Competition intensifying. There are two types. One is the type where we don't think it can have any impact on fundamentals even over a shorter period of time. There we won't respond much, but where we think there could be a dent in defense when our portfolio company tries to play defense for a 6 to 12 month period, there could be some moderation, which is not baked into the share price. If the share price is highly valued, then we'll factor that in. But yeah, competitive intensity is all around. I think across all the stocks in the portfolio, you can see 1 to 2 very intense competitors emerging, which was not the case in this portfolio or even in the broader economy till 5 years ago.
Fair enough. Now, several of you have asked questions on specific stocks. I'll try and avoid that because we're addressing them in the individual portfolio reviews. We're doing it on a periodic basis. But obviously, as many people have asked us specifically about HDFC Bank, I think it makes sense to deal with that in this forum itself. Rakshit, how do we justify having such a high allocation to HDFC Bank? How do we see that panning out going forward? What gives us the conviction?
Yeah, so in fact, there are two types of questions we receive on HDFC Bank, completely opposite. One is, why have we trimmed HDFC Bank? Isn't it the best bank, etc.? And isn't the credit cost cycle bottoming out? Credit cost will increase for the system now, and HDFC Bank is an outperformer on credit quality, etc. So why have we trimmed? from certain level to certain level. And the second type is why are we still holding on to it, HDFC Bank. So I'll try to very quickly maybe summarize 3-4 points. One, yes, we do see a gap opening up between credit quality of HDFC Bank versus others as time progresses from here on. I think when you look at the gross NPAs of, let's say, an SBI versus HDFC Bank, they were less than 100 bips apart in FY24, which is probably an all-time low gap between gross NPAs of SBI and gross NPAs of HDFC Bank. And every time we've come to such low levels in the past, it has been followed by a massive widening of the gap. So we do expect to see the widening of that gap. Secondly, industry growth itself continues to be very healthy in India. And hence, when you combine widening of the gap, industry growth with the PE multiple, price to book multiple that HDFC Bank currently trades at, there is the investment case on the table, which we are invested in. Why have we trimmed the allocation, which is the other polar opposite question? So the degree of market share gains that we saw during the teens, as in, let's say, the 2010 to 20 period, during those 10 years, the degree of market share gains that we saw from great private sector banks when public sector banks were at the receiving end, the quantum, the gap we expect to be far narrower going forward, given the way the regulatory environment is changing to, well, let me just put it that way, given the way regulatory environment is changing the whole banking system to ensure that any systemic risk is taken care of far sooner, right? So, so that gap we expect to be far narrower, and hence the market share gain run rate for an HDFC Bank, which we used to see in the previous era, before all these regulatory changes happened, the market share gain run rate that we see going forward in the current era are relatively lower. It does, as a result, continue to be one of the higher IRRs expected across our coverage universe, and hence it's part of the portfolio, but a relatively smaller allocation than we used to previously hold.
There's an interesting question on our now popular Vesco theme. We talked about the rise of the Indian women, the change in the Indian elite, the dominance of Southern India as a market, as an economy, China +1, and outsourcing. Now, clearly, we can see the W and the E and the S reflected in the portfolio. How are we playing the China +1 theme in the portfolio?
A very good day to ask that question, by the way. So yesterday evening, so divis is one of the largest allocations in the portfolio. And just yesterday evening, US has passed something called a Biosecure Act, right? What does this Biosecure Act mean? If you are a big pharma, let's say a Merck or a Pfizer or whatever, if you are a big pharma and you want to continue giving supplies to US government as a customer, right? And they've got a few programs where they buy medicines from these big pharma. Then after 2032, after 2032, you cannot procure the ingredients of those APIs. And these are all CDMO formulations, as in these are not generic off patent. These are CDMO drugs. The CDMO piece cannot be provided by big pharma to the US government if it is coming from 5 large, clearly named Chinese suppliers in this Biosecure Act. This was passed yesterday evening. It is yet to become a law, which it will in a few months post US elections, perhaps. It is yet to be passed in the Senate as a law. But just to give you an example, if this happens, then the longevity of divis is CDMO business. According to us, it increases multifold, because compared to its competitors like, say, Alonza, etc., we see divis being far better placed on cost of manufacturing and hence cost of supplies and various other quality-oriented parameters as well. So big beneficiary there. That's one. Tube is playing into some of those sectors. There's a lot in terms of exports that we are building out for via escorts, where it has been acquired by Kubota, and Kubota wants to make India the manufacturing hub for its global sales. And they've already got success at the front end in various markets. They just want to shift manufacturing to India. So a lot of that also gets played out here via these two or three companies.
Fair enough. Thank you. The last question, which is ironically opposite in question, perhaps I'll take a shot at answering this. So there are a couple of guys who are asking, look, markets are looking toppy. Why don't you move into cash? There are other guys who are saying, okay, I mean, looks like in a Fed rate cut sort of a situation, or the market's changing texture, quality should do better. So is there a good time for us to top up in the portfolio? I mean, we've been consistent in our explanation for both these things in the past, that we are not big fans of timing the market one way or the other. We believe in asset allocation. We believe you do your asset allocation, you allocate a portion of your assets towards different asset classes, such as equities. Once you've allocated to equities, within that, I'm sure you must be allocating towards large, mid, and small caps. And once you give us the money, we believe this is meant for equity allocation. Therefore, we don't take any cash calls on it, because several of you, including some of our partners, have mentioned that asset allocation is your call. We're here to deliver alpha, which is what our endeavor is. If we end up taking cash calls at our end, it might end up double counting. So therefore, we're clear in our positioning that once you give us the allocation, it's meant to be in equities, and we try our best to put it in the best equities, so that we beat the benchmark, which for the asset class. In terms of topping up, I would say the corollary holds true. We would recommend looking at your asset allocation. If you think that there is scope to add to equities, by all means do that. If you think that CCP, given everything that we've been saying over the past few months, fits into your equity allocation, there is no good time to top up. Having said that, we do agree, given the nature of the market where we are, we do recommend using the STP route in terms of staggering your investments into it. That's at best what we can advise. We recommend you consult your advisor on the asset allocation piece, or if you're doing it yourself, use that as an opportunity to top up or trim down allocations to various asset allocations. Given where we stand in the equity cycle, I would presume that most of you would be trimming allocations to equities, particularly small caps. Within that, if you want to diversify style-wise, clearly we are also seeing that quality is making a comeback, and therefore we should be able to deliver better returns than the broader market going forward. Hopefully, we go back to phase one. Should there be an adverse event in the market where a flight to safety, a flight to quality would mean our type of portfolios tend to outperform. So with that, I thank Rakshit and thank all of our clients for attending it. I'd like to remind that those of you who had questions, we will reach out to you with answers. Please do utilize our offer of doing periodic portfolio reviews, where we can talk about some of the stocks in the portfolio at length. Reach out to our client support team, or your relationship manager will be more than happy to spend as much time to give you comfort on your portfolio. But thanks to all of our clients for trusting us with your hard-earned money. We're trying our best to deliver on that. And hopefully we'll see this trend over the last 6 months of beating the market sustain over the next few years as well. Thank you very much. With that, we bring the call to a close.
Thanks, everyone. Thanks, Pramod.